Hello friends, welcome to Stock Market Free Training Program. In this program, you are being given training of technical analysis course from basics to advanced absolutely free of cost. In this episode, we are going to discuss about the basics of technical analysis. What is technical analysis and how does it work in stock market? Before I start, I would like to give you a brief introduction of the stock market. As you know, stock market is the backbone of the economy, which helps listed companies to generate cash to run and expand their businesses. Stock market is a source to exchange shares from buyers to sellers and sellers to buyers. Companies prefer stock market over financial institutes like bank, NBFC, etc. to generate cash because in banks they have to pay capital amount as well as interest whether their business is in profit or not. But if they go with stock market, they can easily generate cash against their shares and they will not have to pay any interest on it. So this was a brief introduction to the stock market. Now we will discuss technical analysis. First, let us understand the difference between fundamental and technical analysis. There are two ways to analyze a company for trading and investing. Number one, fundamental analysis, and number two, technical analysis. First, we will discuss fundamental analysis. This will help in understanding technical analysis as well. If instead of charts, we check the company's balance sheet and dividend history, etc., then we call it fundamentals. But there are many drawbacks in fundamentals because according to fundamentals, if any stock is trading below its valuation is a buying counter. This means that the stock should be bought at low valuations. But when to buy cannot be known from the fundamentals because the stock is trading below the valuation, it is known, but for how long will it continue to trade at low valuations or will go lower than the current valuation, it is very difficult to predict fundamentally. Now we will talk about the another way of analyzing the stock, that is technical analysis. Technical analysis is used to forecast future movements in the financial market on the basis of its past movements. Technical analysis assumes that we can expect the same move in the future as the stock has given in the past in the same conditions. We use technical analysis in stocks, indices, currencies, commodities, etc. Technical analysis works in same process in all time frames like hourly, daily, weekly and monthly, etc. We use technical analysis every day in our life, but we do not even realize it. Let us understand this with an example. Scientists give us warning of tsunami even before the arrival of tsunami. Scientists also provide information about it in advance, that how destructive it will be and what will be its speed. But friends, tsunami is sometimes less terrible than anticipation and sometimes more destructive than anticipation. But most of the time, the prediction is 100% accurate. This is because it is a forecasting or anticipation of tsunami's past data, and scientists use this data to predict whether a tsunami may or may not occur because it has happened before in the same conditions. This technique which scientists use is called technical analysis. There is also a technique of analyzing the charts, by which the chart is analyzed whether the next move in the chart will be upward or downward or will it remain sideways. This is called technical analysis. The movement of stock is also analyzed in the same way, the way scientists forecast tsunami from tsunami's past data. To analyze the stock, we analyze the data of the stock, that is the chart. The chart tells us the movement of the stock and the price of the stock. Charts are used to store past records in the stock market the way we store our business or home data. But to store the data of home or our small business, we do not need charts because this data is very limited as compared to stock price data. The price moves in the stock market in every second. Our data gets ready by the movement of the price, which makes charts as well as different patterns are also made. We study these patterns in technical analysis, with the help of which we know whether the next move of the stock will be upward or downward or it will remain sideways. Various types of charts are made from the movement of price. There are many charting websites available. With the help of those, we can study charts. We will study line charts and candlestick charts in the technical course, but our focus will be more on candlestick charts because apart from chart patterns, we will also study on candlesticks. Friends, if you have studied only candlesticks well, then believe that you will never lose money in the stock market. We will study candlesticks step by step, that how is candlestick formed and how does chart patterns get formed by candlesticks. And you will be given deep training on how to do trading by executing chart patterns with examples, and you will also be given email support to clear your doubts if you did not understand anything here. You can email us your queries and an accurate answer will be given to you by replying to the email. Friends, support service is also absolutely free. So subscribe to the channel now and press the bell icon so that you will get the notification for the next episode. So let us begin free technical analysis course for stock market trading and investing. Technical analysis is very important for both trading and investing as it gives short-term as well as long-term trend reversal signals. It gives us signals before a downtrend occurs and we can avoid getting trapped in a downtrend. Friends, like we have already discussed that two types of charts are required in technical analysis course. Number 1, line chart, and number 2, candlestick charts. So first of all, we discuss about line charts. How are the line charts formed? The line forms from the price movement in a line chart, and line chart is made from the line, but the line chart can tell us only the closing price of the particular time frame. It can't tell us the open, low and high price. You can select any time frame from 1 minute to 1 month, but you will only get the closing price in line chart. That is the reason in technical analysis the use of line chart is very limited, but it is used to confirm chart patterns because sometimes chart patterns are not that visible in candlestick charts, but when we convert candlestick charts into the line chart, we can easily identify the patterns because line chart only represents the closing price, so it removes the extra noise of open, low and high price. Now only the closing price is available and we give importance only to the closing price for pattern confirmation. This was a brief introduction to the line chart. We will talk about the line chart in details during this course. Friends, now we will study very important candlestick charts. So let's learn how candlestick charts work. Friends, candlestick charts are made of candlesticks. A candlestick can be of any time frame from 1 minute to 1 month. Many candlesticks together form the charts from which many patterns are formed, which we study in the technical analysis course. A particular time frame candlesticks tells us the open, low, high and closing price. With the help of this, we get to know what was today's open price of the stock and what was today's low and high price and today's closing price as well. Friends, the history of candlestick chart is very old. It is believed that candlestick was discovered by a Japanese rice trader Munehisa Homa in the 18th century. Homa believed that the rice market was influenced by the demand and supply as well as the emotions of the traders. That is, the price movement is affected by our emotions in addition to the demand and supply. Friends, this was a brief introduction about candlesticks and candlestick charts. We will study candlesticks in details in next episode. Thanks for watching. We'll see you in the next video. Bye bye. Take care.